Making the first investment can be a nerve-wracking decision. What should I purchase? Whom can you rely on? The terrifying scenario of all is, what if you wind up losing money? The fundamental idea behind investing is simple. Investors frequently make mistakes because of emotion, speculation, and bad advice from others. The secret to achieving long-term savings objectives is investing your money, and it doesn't have to be a difficult or stressful procedure. To get off to a good start in any investment endeavor, abide by these do's and don'ts. Let's look at some of the do's first. Start small. You wouldn't dive into 8 feet of water if you were just learning to swim, right? Similar to this, start small when investing in the stock market. Start with the smallest investment you can and progressively increase it as your expertise and confidence grow. A ton of research. Why should anyone want you to become your own stock analyst when no one asks you to be your own doctor, lawyer, or accountant? Some people like to start cooking for no other reason than they find it enjoyable. Similarly to this, certain people like Warren Buffett take pleasure in the investment process. As a result, if you enjoy independence and are an investor, you might want to think about working as your own stock analyst. It is always preferable to get more knowledgeable on your own, especially with certain analysts' credibility being a large question mark. The first step to thinking like an analyst is to cultivate a questioning mind, regardless of whether you are an investor seeking growth or value. To buy or sell something, you must determine the price. Typically, analysts concentrate on a single sector or industry. They concentrate on specialized businesses within that industry. The goal of an analyst is to thoroughly investigate the affairs of the companies on their list. They accomplish this by examining the financial statements and all other company-related data that is available. Analysts look into the activities of a company's suppliers, customers, and rivals to double-check the facts. To understand the company's operations firsthand, some analysts also travel to the company and speak with the management. Professional analysts gradually join all the dots to obtain the complete picture. It is advisable to conduct your own research before making any investments. Researching different stocks in the same sector will always help you create a comparative study. Information accessibility is typically not a problem. Time is the main obstacle to becoming your own stock analyst. Diversify your investments. You must have heard the saying, don't put all your eggs in one basket. The reasoning is that a farmer can find themselves in a sticky situation if they trip over while carrying the egg basket back from the henhouse. Those words of advice transcend farming and effectively capture the notion of not putting all of your money at risk in one venture. Diversifying their portfolio is one method investors might use to lower their chance of having their nest egg ruined. A diversified portfolio is a collection of various investments that work together to lower the overall risk profile of the investor. Owning stocks from a variety of various sectors and risk profiles, as well as other investments like bonds, commodities, and real estate, are examples of diversification. Together, these different investments lower an investor's risk of permanent capital loss and portfolio volatility. The profits from a varied portfolio, however, are typically smaller than those an investor may realize from selecting a single winning stock. A wide variety of investments should be included in a diversified portfolio. For many years, financial consultants frequently advise creating a 60-40 portfolio, in which 60% of the capital would be invested in equities and 40% would be in fixed income securities like bonds. Others, notably younger investors, have the urge for greater equity exposure. Owning a wide range of various stocks is one of the keys to diversify your portfolio. This entails holding a variety of equities from several sectors, including energy, healthcare, and technology. An investor doesn't require exposure to every industry. Instead, they should concentrate on owning a wide range of top-notch businesses. Investors should also take dividend stocks, growth stocks, value stocks, large-cap stocks, and small-cap stocks into account. Investors should think about holding some non-correlated investments in addition to a diverse stock portfolio. Bonds, bank certificates of deposit, gold, virtual currencies, and real estate are some non-stock diversification choices. Now that we've familiarized ourselves with the do's, let's move on to the don'ts. Don't try to time the market. Timing the market means trying to actively buy low and sell high. Additionally, it is the greatest thing for each investor to undertake. That is, after all, the very definition of how a long position is profitable. You'd get wealthy if you constantly time the market correctly. The issue is that no investor regularly times the markets correctly. Put an end to your concern over market timing, and if the major indices will eventually experience a long overdue 5% decline, most stocks experienced that decline a long time ago. Many reputable businesses are currently offering steep discounts compared to both their genuine worth and where they stood only a few months ago. Don't miss the chance to purchase something while it is on sale. Longer term, everything returns to being valued appropriately. Gaining the most requires entering the market before the masses become knowledgeable. Simply have the patience to wait for everything to return to normal once you've acquired inexpensive stocks. Future account values in your portfolio will be significantly higher as a result. Don't invest according to emotion. According to a survey, many investors simply can't stop themselves even if they know they shouldn't let their feelings or instinct influence their investment decisions. 58% of investor respondents agreed that removing emotions from the equation improves the performance of their portfolio. The poll indicated that 47% of respondents stated it was challenging to control their emotions. Knowing that it is human nature to be emotional and that trying to suppress those emotions is pointless can help you stop beating yourself up. Be honest with yourself about the feeling that has come to the surface rather than attempting to repress it or deny its presence. Find out why you are feeling this way once you have acknowledged it, whether it is due to fear, greed, or anything else. Then decide what to do next using a system that should already be in place. And that takes into account the companies you want to buy, how you will evaluate them, and whether you should sell or buy them. Don't follow the herd. Think back to a time when you were younger, perhaps a teenager, and you wanted to do something because it suddenly appeared popular and like everyone you knew, and many people you didn't, were doing it. You are ready to join in on the latest trend when someone, a parent or a teacher, stops you and tells you no. You complain, but everyone's doing it. The reply is, and if everyone leaped off a bridge, would you too? You already have some familiarity with herd mentality if this dialogue feels familiar to you. When a large group of individuals is present, people often mimic or imitate one another's behavior. Unfortunately, none of us always decide to model the sensible action of others. Herd behavior is sometimes the consequence of imitating the activities of high-status individuals, but it is frequently the outcome of following the crowd. Herd mentality is prevalent in investing in financial decisions, which is in large part because so many people lack a thorough understanding of how the markets work. Emotions can influence financial decisions in the modern world just as much as logic, if not more. We see our friends investing money in what appear to be a wise choice that will increase in value and make us affluent. The majority of individuals imitate that when it occurs. Few people invest the time and energy to conduct the study. Instead, they get carried away by the escalating enthusiasm and hype. As always, when it comes to investing, you need to conduct your study and stick to the path of reason and reality rather than the route of media hype and unbridled enthusiasm. If you can develop the ability to make investing decisions using your conscious mind, you will be able to buy stocks that others may be passing over and sell them before the next bubble bursts. Consult your financial advisor if you don't have enough time to conduct the study yourself. Subscribe for more content just like this one and share it with your friends. Also, don't forget to smash that like button and also press the bell icon to get notified about our new videos. Until then, fellas!